Let's talk about the yen. It's at 147 against the dollar right now. We've had two periods in time recently where we've breached 150, going back to October 2022, and more notably, in the last few months, we got above that all-important 150 mark that everyone is calling the line in the sand. It is not the case. Today I'm going to spitball and talk about dollar yen and our positions in that currency pair. And I want to go back and look at the last 18 months worth of data. So it's going to be a bit of a crazy video with me talking about where the market's gone, a bit on the Japanese credit markets, and where we see the pair heading, and where there's opportunity in Japan, in their equity markets, in credit, FX, across the board really. There's quite a few opportunities, both long and short. So let's just jump straight into it. I'm videoing, I'm just going to talk and share our views. So if we go back to the first time in 22, when we were approaching 150, the cheapest multi-decade low, we have to look in very simple terms at the Bank of Japan, and that they can no longer ignore this, at the time, the excessive risk of currency weakness, this price instability that's been going on. We've been biased since about 110, but to determine that position, we haven't just been looking at the FX, we've been looking at credit, in particular JGBs, Japanese government bonds. And we're big believers that that is the key for potentially where the currency is going. You need to have a heavy handle on the credit market. And there's been various important stages for understanding where the yen is going. It's not so much a case of where the US dollar is going, but where the yen is going. And we've been looking at whether, first of all, the Bank of Japan would abandon their 10-year yield targets for JGBs, whether bond purchases are here to stay. And if we go back to the meeting, just before the meeting that they had before we approached 150, Bank of Japan meeting, and the tone that they were using, they were talking about, for 2024, wages and price trends will be ticking higher, and that Japan is gradually transitioning to a world in which the overall inflation expectations are rising, and these price norms are becoming more normal, which is unusual for Japan. This year, it's all going to be about the Japanese corporations. We're building various credit models on them, and we're looking to see whether there is money to raise wages this year. Is yet to be seen. But on the topic of inflation in Japan, a bigger inflationary environment could actually be, you could spin that off as a positive. Given how much of a beating the currency's taken, last 2 years in a row, it's been the worst performing G10 currency. So it's very interesting there. You can position for that. But when we look ahead, is the risk of further decline, are we fully baked in now? Is there room for further downside? What is the Bank of Japan doing for their yield curve control? Is it now a more flexible approach? Because if we go back to the summer meeting last year in July, they were talking about they were adopting a more flexible approach to yield control. And what we've seen there as a result of that is that the size of the spread between US and Japanese rates has reassured those that are buying dollars and those that are selling the yen. But we need, in order to find a reversal trade, to actually be overweight and bullish on the yen, there's a few catalysts that we need that can take time to basically come into play. First things that we've been looking at is how the Bank of Japan are managing the yen swap rate curve. So from the information that I've found, it's pretty clear that they are using what we call pooled collateral fund operations, which essentially they're trying to slow down the swap curve, the yen swap curve. and swap rates, but we're in a largely unknown part of the market right now. So it's very interesting to see where we can head with that, and what we can see with rates going forward, whether they can rebuild, because a big problem with Japan is if they can rebuild their foreign bond holdings, but also their local currency holdings and their yen holdings. So you'll see a sharp rebound in yen if they can succeed in that, because they're lagging behind massively. And if we go back over the last 3 to 4 months, we've seen that the swap rates have risen considerably. And it's mainly from these, I've talked about this before, this ripple effect from the Bank of Japan, their surprise decision to initially expand the range for their 10-year yields. We're coming off the back of that. We've had 4 months of cooling and we're not quite still at that point yet. So I think there's quite a few things to note on what they can do, and the appeal for Japanese government bonds and the yen could start to rise. But there's a few things to note. If you're looking at the belly of the yen swap rate curve, you're seeing it fall, while to start this year, you saw that the long end for pretty much all of this month has risen. So you had 10-year yield that was below the 0.5% ceiling under the yield curve control. And in the first 3 weeks of the year, we've seen about 3.4 trillion yen of overseas securities bought up from foreign investors. Yet, when you look at the breakdown of that, a lot of the foreigners are actually reducing their exposure to Japanese stocks and government bonds. So, interesting times for the yen. If you break it down and you really zoom out, what we've actually seen, or if you want to call it the key theme, has been dumping of foreign bonds from Japanese banks and local investors, and they're buying up other, places that I would describe as not desirable. They're still buying. So they're buying up UK non-sovereign bonds. Japanese investors are letting foreign investors take the hit on their own JGBs, which is a bit scary. So lots to be watching. And as I say, this video is purely an information dump to explain the reasoning behind basically where we stand at the moment with the market and where you can make money. There's so many opportunities. We've been betting on US-Japan rate spread staying pretty wide. It's been a pretty good investment with all of the targeted, as I say, yen selling, offloading by foreign investors and speculators. So even when you look at long-term government bonds, the selling hasn't wound down that much yet. So be interesting to see if we go back and look at the exchange rate. Towards the end, the Q4 of last year, touching that 138 level, then back up to 140, 141, now back up to 148. We're really pushing to break this level. So be interesting to see, as I say, tracking the flows of unloading of these bonds, the stronger impact on the Japan, the basis for tightening down the line this year. Yet the unique thing and the funny thing is that a lot of the foreign investors have actually oddly helped to balance out the front end on the yen curve. So when you've got downward pressure on bonds slowing, i.e. less people dumping them, the front end will slowly tick up and it will keep the spot market. And what it's done is it has kept the spot yen suppressed because of that. So let's just break that down a little more. Because you've had Japanese investors unloading foreign bonds that they picked up, and I noticed that they were buying UK non-sovereign bonds, particularly for some reason. What you've seen is that the Japanese investors have been selling, offloading their foreign bonds, which has had a stronger impact on the case for tightening Japanese yen. And yet what it's actually done is balanced out the front end on the yen curve, because this downward pressure from government bonds has been slowing. We've had less people, foreigners, dumping, but local investors selling. So because of that, the front end has come up, and it's keeping the yen from moving much higher, from appreciating at the moment. So very interesting times. The bad news or further declines could happen, and this is one of the scenarios, is if the majority of the Japanese investors, when they're done unloading their foreign bonds, then you could start to see the rebuild of new foreign asset positions, and they can move into G10 bonds, US bonds, specifically after midterms. There's a lot of options for them to move into. So very interesting to see. They could move into arb trades, currency trades, which would then affect it. So there's a lot to pay attention to at the minute. And people may or may not know, but there's a 3-tiered structure basically that the Bank of Japan are running right now on their current account structure. For those of us who are making bets on where this will go, I will do another video, a presentation talking about the moves there and what we can expect to see. But let's just quickly drill into the Bank of Japan, because they're one of pretty much a handful of major central banks that are not doing policy tweaks yet, and the rates are not going up. We've just had the surprise earthquake in Japan. I think that's made them not want to raise rates unexpectedly as well. Let's talk about the yield curve control. It's barely working, this flexible control. They've got an upper limit of 1%, which is double the previous level, which is quite alarming. The response to the yen is still pretty muted, I would say. And this is going to change the debt market, the global debt market, because we've typically, when you look at it in the past, we've always seen the Japan government bond yields rising, and as the domestic investors, they unwind their foreign holdings and things like this, whilst they put the proceeds back into the local market. Some interesting facts, given that the Japanese government debt represents 16% of global sovereign bond indexes, it's going to be what we call an eastbound flow of capital, which could very easily start what we call a ripple effect to revive a flagging yen. We haven't seen the safe haven bid that we typically see yet either, so that's a scenario for a bullish case on the yen. So let's see what happens. So these are just some remarks. I hope that clears up some of our views on the yen.